Ayala Land is considered the gold standard of real estate development in the Philippines. Investors, institutions, OFWs, and even competing developers still look at it as the benchmark for quality, stability, and long-term execution. But even the strongest company can be affected when the overall economic environment becomes weak. That is the real reason why the stock is trading at around 19 pesos, one of its lowest levels in more than a decade. The question today is not whether Ayala Land is still a strong company. It is. The real question is whether even the strongest developer in the country can grow when the entire Philippine market and economy are struggling. The bigger problem is the macro environment, and the Philippine stock market has been flat for almost 10 years. Meanwhile, global markets like the S&P 500 continue to hit new highs. Countries like Vietnam, Indonesia, India, Malaysia, and Thailand are attracting foreign money. Their stock markets are growing while the Philippines is stuck in a slow cycle. Ayala Land reflects that weakness. Political noise is one major headwind. Sentiment around Ayala Land went from positive before the pandemic to cautious today. That change affects real estate heavily. Investor confidence dropped, projects faced uncertainty, buyers became more hesitant, and profit margins became tighter. Even people who want to buy property now have to deal with mixed signals. So many choose to delay. There is also oversupply in the property market. Office spaces have some of the highest vacancy levels in history. This comes from POGOs leaving, companies shifting to hybrid work, and many businesses reducing office space. But new buildings are still being completed, adding even more supply to a market that is already soft. In the residential market, thousands of units launched in the boom years are now being turned over in a weaker economy. Foreign investors are also not returning in a meaningful way. Instead, global funds are choosing Vietnam for manufacturing, Indonesia for natural resources and EV projects, Thailand and Malaysia for tourism, and Korea, Taiwan, and Japan for tech and export-driven growth. The Philippines does not have the same strong story that attracts foreign capital. Because of that, companies like Ayala Land lose potential buying pressure that could help the stock recover. Now, to be fair, Ayala Land is recovering. Malls are busy again. Hotels are doing better. Construction activity is back. Their estates remain well-planned and attractive. Financially, the company is stable, but the recovery is slow, and the current economic conditions limit how fast the company can return to full strength. Margins are still being pressured because borrowing money is expensive and construction materials cost more. Leasing businesses like malls and offices are stable but not strong enough to push a fast recovery. Residential pre-sales are improving, but they are far from the level seen during the strong growth years of 2015 to 2018. If we look at the stock price today, some people may think it looks cheap because it used to trade at 35 to 48 pesos many years ago. But valuation is not about comparing to old highs. Valuation is about analyzing if today's environment can support those prices again. Right now, we have to wait and see how long before the political uncertainty changes, and also when foreign investors would come back in. This situation is not unique to Ayala Land. Property companies around the world are under pressure. China is dealing with a major property crisis. Hong Kong prices corrected. Europe dealt with rent freezes. Even property companies in the United States dropped when interest rates increased. But here is what makes other countries different. Many of them have strong foreign demand. Thailand, Vietnam, Indonesia, Malaysia, and even Singapore have clear growth stories. They have strong tourism, strong manufacturing, pipelines, or strong export industries. The Philippines does not have the same level of external support. Tourism in the Philippines is still behind Thailand, Indonesia, Malaysia, and Vietnam. Manufacturing investments continue to choose Vietnam and Thailand instead of the Philippines. The peso remains weak. The stock market lacks foreign volume, and investor confidence is low. All of this creates a heavy environment for Ayala Land. The company is strong, but the environment around it is weak. Until the macro situation improves, Ayala Land will continue to face challenges. Ayala Land is one of the most well-managed and stable companies in the Philippines. It has the size, the experience, the brand, and the assets to survive and eventually recover. But growth depends on the entire Philippine economy improving, not just on the company itself. Some investors prefer to get income while waiting for recovery. For that purpose, Ayala Land REIT offers clear dividend payouts and more predictable cash flow. Ayala Land requires more patience and belief that the Philippine economy will improve in the coming years. One is an income play. The other is a long-term turnaround play. To summarize the honest conclusion, Ayala Land is still a strong company, but the Philippine macro environment is not strong enough to unlock its full potential yet. The company is stable, but the economy is holding it back. ALI is not a bad investment, but it is also not a fast recovery story. It sits in the middle, waiting for the country to improve. If interest rates drop, if foreign investors return, if tourism strengthens, and if overall confidence increases, Ayala Land can recover. But until then, patience is required. Ayala Land remains the gold standard, but even gold can stay buried for a long time if the soil around it is heavy. We all wish the PH market could zoom like the US. We really do, but our market is different. Shallower depth, thinner liquidity, different sector leadership, S&P 500 surging, Nasdaq surging, on dominant tech leadership on massive scale, on consistent capital inflows, on clear growth narratives that pulled money in. So what would a zoom look like here? Broader participation beyond a handful of names, stable policy signals that reduce risk premiums, improving liquidity across the board, clearer stories in tourism, clearer stories in manufacturing, clearer stories in digital infrastructure. The levers are practical. Lower rates over time, not overnight. Predictable regulation that sticks. Capital markets reforms that deepen local pools. Openness to foreign participation where it counts. And stronger earnings visibility from local champions, including ALI when pre-sales and malls truly re-accelerate. For investors, the mindset matters. Patience over prediction, discipline over drama, dollar cost averaging into quality, avoiding hype trades that fade with the headline. We watch for gears to align, traffic to flow, runway lights to guide the landing, dominoes to line up, then tip. Because tides do turn. Liquidity returns. Narratives consolidate. Earnings follow. Our job is to be present, not frantic. To build positions, not chase candles. When the tide finally turns, we want to be positioned, not chasing. That's how we catch the zoom.